Hello, everyone. Hope you had a great Diwali and wishing you all a very healthy and a prosperous new year ahead. This Diwali was different. Like after 2 years, we saw festivity. We could see that in the streets, crackers, lights, and also in the shopping. Like we could see most shopping areas very, very full in India. And that's always good to see, given how much small businesses and small traders have got impacted in the last 4 or 5 years. You could see that people going out and shopping from the small shops and some of the small businesses. That's always very, very good for the economy. And you could see uh, activity on the streets. And from the commentary that we are hearing from companies, consumer durables, auto, uh, the consumer discretionary, you're seeing very, very strong numbers. Some of them have posted record sales and record Diwali. Of course, India's favorite asset, gold. Dhanteras had some record buying that was reported. So these are all good signs that people are sentiment is getting better. People are not bogged down by COVID or by loss of family and or lockdowns, and they are expressing that sentiment, that positive sentiment, by spending and consuming, and that's always very, very good to see. Uh, this also leads us to the point that what we've been making, that the growth in the economy is getting broad based. What we saw between 2016 and 2020 was a very narrow growth. Most segments were not doing well. Small businesses were getting impacted, but maybe we are seeing the first signs that still large companies are doing well, but the smaller companies, smaller SMEs are coming back. And that's always good to see, because they are the ones who create jobs, right? So one data point to see there is credit growth. So we've seen a significant increase in credit growth in this like 14-15% growth. And if you break down that growth, it is driven by PSUs, which are back in the market. They've cleaned up their balance sheet. Government has given them capital and they are back in lending, and they're lending incrementally more to MSME. And that's again very, very good to see, because that means that risk aversion has gone down. That segment is doing well and is asking for more credit, which means it is seeing demand. And that portends well for our biggest problem, which is job creation. So that entire broad basing of economic activity, I think it is progressing very well. And we are seeing that in tax collections. We're seeing that in sales of certain companies. We're seeing that in GST, movement of GST and e-way bills. So some issues, but mostly on a good path of recovery. What we started saying in August 2020, that India is on a cusp of a economic recovery, and I think that is progressing very, very well. And it is showing in the markets, right? If you see India's performance relative to any other country has been pretty good, especially October was a very, very strong month of returns. Foreigners are coming back. You're seeing foreigners who are net sellers. There have been some buying in the last week or 10 days. And that's always good to see. Earnings growth seems to be muted, but the revenue growth has been. Earnings growth is muted because costs have gone, and so margins pressure are indicative. And I think companies are holding prices to ensure that they don't lose out on market share. So they're gaining volume growth, but margin growth is lower. So, but still, we have seen commodity prices come off, which would mean that earnings over the next 12 to 18 months should recover from that huge spike that they've seen. We're also seeing Indian bond markets getting attractive. The 10-year bond yield is at 7.5%. If I look at a 10, 20-year horizon, average 10-year bond yield will be about at around this level, 7.4 around, which means that the 10-year bond yield is at the normalized average. This is different from global markets, right? Global bond yields are way above long-term averages. Global inflation is way above long-term averages. Indian bonds, Indian interest rates, and Indian inflation is around its long-term average, maybe slightly higher, but just around it. So Indian businesses, Indian investors have seen and have experienced these kind of interest rates and inflation, and have managed and dealt with it. which is what is different in the global world. And so in the bond market also, Pankaj Pathak, who runs the fixed income funds at Quantum Mutual Fund, has given a very clear call on investors should be looking at the bond funds and longer term bond funds, or what we call dynamic bond funds in India, given the fact that interest rates have come up and it's getting into the attractive zone. The global markets remain in trouble, especially in European area, where the impact of inflation, war, and that high interest rates that they are experiencing is causing a significant slowdown. We are seeing what they call a pivot by the global central banks, but the pivot is only that instead of hiking 75 basis points every meeting, the pace of those hikes will slow down. We still don't know whether the US Federal Reserve or the Bank of England or the European Central Bank will pause. They will keep hiking, but at a slower pace. Maybe the next hike will be 50 or 25 basis points. And so markets are taking that as a fact that, okay, this is a peak, but we still don't know yet. But the reason they are doing that is A, they have hiked quite a bit over the last 6-8 months. And B, financial stability concerns are getting, like what NRIs who are in the UK would have known what happened in the UK and how the Bank of England had to step in and calm the markets. And there's always a financial and market stability impact, which has to be taken in contrast with what is happening in inflation. So maybe the balance has now maybe shifting from not only inflation to inflation and economy and financial markets. Having said that, global interest rates will still remain higher than average, and will remain at that level for some time before central banks are very sure about inflation coming down. Which means for non-resident Indians outside India, your money in your bank account, money in your money market fund is now earning much more than what it was earning, say, 5, 7, 10 years back. And you need to be careful about it. You need to be aware about that and ensure that you make the most of your idle savings by getting advantage of the fact that interest rates are higher. But I would still say in your international global investment, be cautious. There are still many pockets of stress, like EM debt and EM currency, valuations in the private and venture capital markets, where we've seen a lot of family office and high net worth investor money going, and of course whatever risks that comes out of China, which is why India is standing out, both in terms of geopolitical and politics, but also in terms of the underlying economic activity, underlying interest rates and inflation balance, and the retail money that is there in India going into equities and and mutual funds, and that's always good to see. And we would believe that even foreigners, as they've seen, EM investing has not worked, like just buying the EM index or just buying a passive ETF and having very high weights to countries where the returns have been very poor, like China. I think all large institutional investors will take a relook sometime in 2023, saying that how do they want to approach their global investing, and in their basket of products that they want to choose, or country allocations that they want to make. I think India will and should play a very big part, and which is why we are fairly optimistic that India will see large global flows, unless we do something very bad, like either the macro situation goes completely out of hands or the political situation goes completely out. If we manage these two aspects, I think India has a very good runway, not only in the next year, but over the next 5, 10, 15 years. In the short term, I would point to one risk in India that we see is oil prices and its impact on the Indian currency. Given the fact that global rates are so high, normally India's approach to deal with the currency problem, if it comes, is to tap the NRI market, issue a India Millennium Deposit or resurgent bond in the 90s and early 2000s, and the 2013 FCNR deposit scheme. Because global rates were low, India was offering a very high rate in dollar terms, and NRIs, used to invest. Given the fact that now today NRIs can earn 4, 5, 6% in their dollar bonds or UK or pound or other currencies, it will be that much difficult for India to tap these NRI flows and NRI bond flows. So India has to be careful in terms of, if oil prices go to say above 100 and stays there for a period of time, then in 2023 we should see a impact on the rupee, and the rupee may depreciate, because RBI has already protected the rupee from depreciating by selling its FX reserves. If oil remains high, then the demand for that will be higher, and you should see some INR depreciation against the dollar and against other currencies as well. Otherwise, if oil remains between 1800, I think then we are good. Rupee, they should be able to manage rupee in a steady depreciating manner, which is always good for instruments and investments. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.